studio with my sidekick, Jennifer.
Good afternoon.
Welcome back.
Thank you.
From the camping trip?
Yes.
Good to have you back. You survived.
Yes, I did.
Great. Well, remember, you can call us live at 512-643-5483 or send us your questions and comments to ask@fortwm.com. You know, times are always changing, and it just seems like they continue to change even faster and faster as time progresses. And, you know, looking at the stock market, looking at commodities, looking at futures, looking at countries, wars, all of the things that are going on right now, it just seems like things are happening faster and faster and changing. And you probably know that really financial planning's changed as well, because we live in a different world than 30 years ago. So there's definitely been changes in the financial planning industry that I've seen, and big changes even within the last 5-10 years. And every year, more and more changes. And what's important is to recognize where we are today and have what I call forward-looking models. Think about what's going on today. Sure, look at the past, but remember that the past has already happened, and things won't completely repeat themselves exactly the way they happened in the past. But moving in the future, you know, we got to look at where we are today. You know, number one, pensions have virtually disappeared. Homes don't appreciate like they did for our parents and grandparents, and college costs have skyrocketed and continue to skyrocket. You know, there's definitely things that inflate faster than the CPI index. Meantime, stocks have, you know, for many people have been disappointing, the stock market. People that retired in 2006, people that retired late 90s, had a bad time with the market collapsing basically on them, and then having a retirement plan that was situated around that being solid. But if you learn the new rules of the game, struggling and fear could just fade away. We want to make sure that you know those things that you have available. And we shouldn't be planning, you know, a retirement that's going to include a large amount of fear. We should have more sense about things. And you're going to really want to stay tuned to hear Sean Quigley's new approach that takes away all those unknowns as you transition into retirement. With the cash play approach, you have the cash for your lifestyle needs no matter how long you live. And before we get to Mr. Quigley, I just wanted to make another point that I try to make on this show, and sometimes I'm not so eloquent. You know, it's definitely a specialization world nowadays. When we look at different industries, we look at the medical industry, we look at any industry, pick it, name it. You know, plumbing. You know, you've got specialists there, I'm sure, right? You've got specialists all over the place. And, you know, in our industry, in the financial industry, it's the same way. And if you're looking for advice on a particular thing, whether it's, I just want to take my money and buy lots of options on the market, then you probably want to go and visit with somebody. If you want advice, get advice from the person that really specializes in options trading. If you want advice on how to not outlive your money in retirement, and spend as much as you can, but not outlive it, and not take more risks than is necessary, and do that the right way, you probably need to work with a retirement planning specialist. And there is a difference between a specialist and a licensing type of duty, where we talk about fiduciary duty. We've mentioned that before, where your best interests are placed ahead of the interests of the financial professional. Well, of course, that's important. But what if you're visiting with somebody that has a fiduciary duty to do what's right by you, but they're not a specialist in what it is that you need advice on? What happens if you go and you try to get advice from somebody that just buys and sells options? Now they have a fiduciary duty to you, and you say, but how do I not run out of money in retirement? How do I do this retirement thing, knowing where we are today with the world the way it is, in a low interest rate environment, with a volatile stock market, with, you know, massive amounts of government spending and debt, and some uncertainty as to what the future may hold? How are we going to do that? Well, you probably are not going to get the very best advice when it comes to retirement planning from an options trader. That's just my understanding of it. So, and that's what we do at Fort Wealth Management. And of course, that's why I have an affinity towards that and some bias and retirement planning, because that's what I do day in and day out. So when I come to this show on Saturday, I had already had a long week working with people just like you, trying to help them figure out how they're going to live the retirement of their dreams and not live in fear and have the stress that is sometimes associated with an improperly developed plan that's not well executed. So Jennifer, can you give us a little information about Sean Quigley,
Absolutely.
Our guest?
Sean was a successful entrepreneur for 18 years before he moved into the financial services industry. He was named Rookie of the Year with his first national company. He earned membership in the $1 Million Roundtable after being named All-American for 2 years and National Champion Agent. He's also author of The Cash Play, Capitalizing on the Opportunity Value of Cash.
Welcome, Sean. How you doing?
Thank you, Justin and Jennifer. I'm doing great. Thanks for having me.
Well,
I love.
Go ahead.
It's very refreshing to hear what you're talking about and how your approach to financial planning, and this is really what I'd love to see more and more advisors do. And when I travel around the country, I think I've been in 36 states so far, working with advisors and many times their clients, and talking about this, that it is a different world than our parents lived in so many regards. And there was a lot of risk taken back then, and going forward, I think the reason we named the book The Cash Play is because we're trying to teach people the importance of being intentionally liquid at all times, not just in these times when the stock market's kind of at its peak, but to be even brazenly liquid when your CPA and others are telling you, you should be putting your money in qualified funds or keeping it to stay in the stock market.
And Sean, can I stop you for a second? I just want to jump in.
Sure. Sure.
What you're really talking about is you're talking about how cash is king. You're talking about the old idea that you're much better off if you have the ability to do the things that you want to do, and you can't do those things if you don't have access to your wealth and the means to be able to move that money around as you see fit.
Exactly. And at least a portion. Have balance in your portfolio. What we talk about in the book is to be fundamentally sound in your investments. When there's opportunity to get a match on your 401k, that may make sense. But also, I talk a lot about in the book about using permanent cash value permanent life insurance, and even funding it up to but not over the MEC limit. Just really piling money into that thing, and having that accessible when possibly the stock market's down, or if you have some kind of medical need. My wife has cancer, and I'm able to access cash for alternative treatments that aren't covered by insurance.
Yeah, Sean, what you're describing to our listeners right now is exactly what we as financial planners, retirement planners, want for our clients, is to have a well-rounded position in everything that they're doing so that they can better weather the variety of storms and risks that life will throw at them throughout retirement. And Sean, I'm very excited to jump into your book here, talk more about some of these really, we might call them unorthodox ways to position retirement assets, but you know what? They're very logical, and a lot of financial professionals, myself included, that understand how to use these tools to your best advantage. We do use these. We want to help you understand what you might be interested in for you and your family. And when we get back, we're going to talk more with Sean Quigley. I'm Justin. This is Retirement Journey Talk 1370. This is Talk 1370. You're listening to Retirement Journey with Justin Fort. You can call us live at 512-643-5483. Send us your questions and comments to ask@fortwm.com. We are super excited to have Sean Quigley with us, author of The Cash Play, Capitalizing on the Opportunity Value of Cash. Cash is king. And Sean, what is the cash play approach in a nutshell?
Well, the cash play approach really is looking at where all your assets are and like I said, trying to be intentionally liquid or even brazenly liquid in your approach. So you want to be able to seize on opportunities. So when in 2002, 2008, and even in the last couple of months, we've seen this market downturn. Who are the ones that really are able to take advantage of those situations? And it's the ones that were in cash or some portion of their portfolio was in cash. So if you have a large bank of cash in your cash value permanent life insurance, you're able to the rest of your investments will be optimized. So if you can wait out the downturn, so if, say you have you're in retirement and you have all this qualified money in an old 401k and the market's down, you'd rather let that market recover. So if you can be pulling out of a cash bank of some sort, even if it was cash in a savings account. But I really like the idea of a permanent cash value life insurance because now you're using it as collateral to get a loan from the insurance company. Your cash value is growing compounded with a sizable dividend rate, and typically you have a low simple interest loan from the insurance company, so your money's growing while you're using it.
Right.
So you're able to.
And Sean, can I jump
Sure.
in here real quick and just add my my little fiduciary disclaimer and everything to what we're talking about here? So insurance companies, what you're saying is that we can use you've done this with your clients or people you're working with, that you can use a life insurance policy to get some guarantees from the insurance company. Well, of course, we want to make sure that the insurance company is strong. Their claims paying ability is based on their strength. There is some insurance guarantee association numbers that you can look up through the various states, depending on where you live. Here in Texas, there's the Texas Department of Insurance website that can help you see what we call reinsurance guarantee. But essentially, Sean, what we're talking about is another alternative, I suppose, to stock market, where that alternative could be protected in some way by an institution, whether it's a bank, government entity, or an insurance company. In this case, we're talking about an insurance company. And the reason you're talking about using a life insurance policy, and you're not the first. I mean, I've read, there's numerous books and numerous people that are really big into this. And so I don't think that this is on the fringe. This is very much part of financial planning in the center. To use things like this. And really, I think that the major benefit that I've seen in using tools like this with our clients at Fort Wealth Management is the ability to make decisions, to pull money out, put money back in, kind of almost having that reserve there when it's needed, having the protection of life insurance in case death happens earlier on, and maybe early in retirement before Social Security's really paid out a lot, or other pensions have paid out enough, but then also reaping the benefits of the tax-free nature of loans, because the government can't tax us on loans, right?
That's right. And I talk about the tax control triangle in the book. And so you have three types of accounts. You have a taxable account, which is when you take after-tax money, you put it in, say, real estate, CDs, mutual funds, and any kind of business interest. And so you take an after-tax money, you make this investment, and now any gains are taxable. So that's a taxable account. So you're really getting a double tax. But then you have tax deferred, which would be your traditional IRAs, tax sheltered annuities, tax deferred retirement plans such as qualified 401ks, 403bs, and that's a little better because you're not paying the capital gains, but you're going to be paying possibly, where it used to be said you'd be saving on taxes by putting your money in a 401k or traditional IRA. Well, that was when taxes were very high, and they did come down, so you did save on your taxes. Well, in this new world, we've been funding these programs when the taxes are near historical lows for 30 years. So when that money comes out, there's a possibility, it's not certain, but there's a possibility you could be paying higher tax on that money. So instead of saving, you could, it could be the alternative. And then then you have the tax-free accounts, which are the Roth IRAs, tax-exempt bonds, and permanent cash value life insurance. The thing I like about the life insurance, I'm not going to keep, talk all about life insurance, but you don't have those restrictions of waiting till 59 and a half, because I don't like putting my money into an account where, say, I start at age 20 and I can't touch my money for 40 years without penalty. So with the life insurance, you have access to it for your kids' college. I like it as an alternative to a 529 because when you think about it, a 529, if it's invested in mutual funds and sorts, if the market's down when your child's in college, you have to take it out at the low because it has to be used for college. If I was to go to a bank and open up a savings account and they said, sir, this account can only be used to buy a boat. And I say, well, I like boats, but I'm not sure I'm going to want a boat. And they say, well, I'm sorry, sir, if you don't use it for a boat, you're going to be paying a 10% penalty on that. On the growth. And you say, well, don't you have a savings account that I can use for anything? Well, and that's what the life insurance does. So we're trying to fundamentally look at these, it's very important people sit down with their advisor and dissect it down. What is this account being used for? How does this fit into my big picture for my life?
Yeah, what's the purpose behind this investment or that investment, and what are we giving up by putting our money here to get this maybe minor benefit, but are we closing the doors on the opportunity cost of having access to those funds and maybe even potentially receiving a penalty if we try to access the wealth that we've decided to put into something like a 401k or 529? And if you're just tuning in, we're speaking with Sean Quigley, author of The Cash Play, Capitalizing on the Opportunity Value of Cash. And this is the retirement journey with Justin Fort, where it's all about the health, wealth, and freedom you need to live life your way, all the way. I'm Justin, and remember, you can call us live at 512-643-5483 or send us your questions and comments to ask@fortwm.com. And, Sean, as a retirement planner, a financial planner, I have to try to imagine all of the potential contingencies or things that could come up to a certain degree within reason, prudently, right? We wouldn't want to put all of our money, for example, in any extreme sense, say take $1 million and put it all in cash and just have it sitting there in cash. We might want to have, some emergency funds for different things, but we might want to fund a life insurance policy to a certain amount. We might want to have some money in the stock market. We might want to have, but we want to make sure that we don't have what I call perfect storm events, where we're looking at one, let's say, bucket of money, or we're looking at one position of money, and we're saying, okay, that money is going to do a number of things for me. I'm going to grow it in the stock market. It's going to be there as my emergency money. It's going to be there if I need long-term care. It's going to cover me for that. It's going to cover me for this. The problem with that kind of thinking, really, is that if we have a perfect storm event where, let's say, markets go down and you need long-term care, then that money is not going to be good for that as well as your retirement at the same time. You're going to probably run out of money then. And if the goal is to not run out of money, we got to position things, in a prudent manner.
Exactly, Justin. You nailed it. I mean, this is what I like to see. I mean, you're looking at everything, because we'd love to think that my 401k will be at its peak the day I retire. I don't care what's happening now; it'll be at its peak when I retire, and there will be so much money in there. You hear about these. You hear these radio personalities say you make 12% compounded in the market. Well, if you're making 12% compounded the rest of your life, that's spectacular, but that's an average. It doesn't even happen. It's never happened. Probably never will happen. We can't set people up for that just think in this bucket of money they're going to be self-insured at a certain point. They won't need anything. The cost of nursing care in this country is going through the roof. If you don't have a plan And I tell people, start backwards, because you don't want to be 85 and say, I wish that younger me would have thought of this. You better have some plan, even in your early 40s, to be thinking about what's going to happen when I get older. And if you have a plan for all those contingencies, all those things that can happen, you can enjoy your retirement and spend down your retirement money because you know you have the back end covered. If you don't, you're going to have to save, hoard that money, hold on to it, and not live such a good retirement, and not be as charitable, to your church or to your community, because for fear that you may need this money at the end of your life.
And Sean, when we get back, I've got to go to a quick break here, but when we get back, I want to talk about cash play, planning, using life insurance, Roth accounts, other things, instead of potentially paying off a mortgage, and what you say in your book and how you feel about that, because I know a lot of people have that on their mind. Should I or should I not pay off my mortgage? Is that the best way for me to better secure a secure retirement? And again, you're listening to The Retirement Journey with Justin Fort, Talk 1370. Talk 1370. You're listening to Retirement Journey with Justin Fort. You can call us live at 512-643-5483 or send us your questions and comments to ask@fortwm.com. We're visiting with Sean Quigley, our guest today, author of The Cash Play, Capitalizing on the Opportunity Value of Cash. His website is thecashplay.com. And before we went to break, I mentioned that we ought to talk about paying off a mortgage and whether or not that makes sense, or are there alternatives? Are we locking up our money? What about all these things?
Yeah, Sean, let me ask you. Many people believe that the most effective financial planning involves buying term life insurance, investing in the markets, and paying down your home mortgage as soon as possible. But do you necessarily agree with that?
Yeah, how has that plan worked out over the last 30 years? You bought term insurance, you invested the rest. Supposedly in 20 years you're going to be self-insured. You'll have so much money you won't know what to do with it. Well, 20 years later you realize, wow, the money's not there. Mm-hmm. Stock market hasn't performed like I thought. But the mortgage has been the number. When I ask people what is going to be the biggest expense in your life, and they'll typically say their home or their student loans or whatever, and I tell them that your biggest expense is going to be taxes. So the way that you position yourself tax-wise is very important. Your home is not an investment. There's no gain on equity. Your home is an expense. And so people think of it as a debt, and they think, well, I just don't like this coupon coming in the mail. Well, when mortgage rates were 18.63% at their height in 1981, and the home price was maybe $50,000 at that time, you thought, well, yeah, that's a credit card payment. I want to pay that down very quickly and get that out. And maybe it made sense at that time. But over the years, each tick down, people would refinance 18, 17, 16, 15, 14, 13, 12, 11, 10, 9, 8, 7, 6, 5, 4. The reason I say all those numbers is because it was a slow boil. We didn't realize what was happening, but it became a different world. Every time the mortgage rates came down by 1%, people said, well, for the same payment, I could pay more for that house. So what was a $50,000 house is now $500,000, and we're at 4% rates. I hear people say, "Well, I'm going to wait because I'm going to wait till they go down to 3.75." And think about that. Well, when I graduated from college, I remember my brother-in-law standing on his driveway. There was a blip in the system for 10 minutes, and he got a 5% mortgage. And his broker locked him in it. And I thought, oh, my gosh, you don't pay interest. He said, yeah, I don't pay interest for 30 years. Now we're in that world. We become so accustomed to it, we think that this is going to happen forever. Well, you better be taking advantage of this. I don't care if you've already paid down your loan or whatever you're doing. Having access to that money at that rate and being able to write off that interest is tremendous. But the fact that you're buying a $500,000 home, if you're coming out of college right now and your parents tell you, you better pay off that $500,000 home before you start planning for retirement, what we're already seeing is people are getting age 65. They've got their money in their home. They got their money in their qualified plan, but nowhere near the amount of money that they need to live 30 years in retirement.
Right. And Sean, what we're really talking about is that what you're explaining, if I could kind of summarize, is that times are different, and that different times call for different planning techniques and strategies. And that's what's very important for all of you listening right now, is that you have to be working with financial professionals. If you're seeking advice or you're looking for proper advice, you need to be working with financial professionals that are looking towards the future and considering current events, and not sitting on their laurels, relaxing on old data and old methodologies. And it is true that most people that I speak with, Sean, tell me that, when asked, that they believe that taxes are going to go up. When asked, they believe that interest rates are going to rise. We don't know when, they don't know when, but they're very aware of these things. But then the question is, what do we do about it? And, if you're just tuning in, this is the Retirement Journey with Justin Fort, where it's all about the health, wealth, and freedom you need to live life your way, all the way. We'd love for you to call us live at 512-643-5483, or send us your questions and comments to ask@fortwm.com. Sean Quigley, who we're visiting with today, is the author of The Cash Play, Capitalizing on the Opportunity Value of Cash. And what we're talking about really is, what are the tools that you need to be using to better position yourself in a new world, in a new environment, with a forward-looking model, considering these risks that may come up. And, can we get two birds with one stone, or three birds with one stone, Sean, in some cases with the Cash Play plan?
Yeah.
I.e. long-term care, i.e. taxation, i.e. market risk.
When you look at these, you tend to see that cash value column, and you're thinking rate of return. Well, this rate of return versus what I made on some stock or whatever. Well, you have to factor in that if you have permanent life insurance, you're not going to be paying for term insurance. And every year I go in and I give a class to the University of Nebraska College of Dentistry students, all the graduates, and it's a lot of fun because they're excited to talk about money after doing all their dental labs. But we talk about these issues because I calculate for them a 28-year-old graduate out of dental school buying 20-year term for 20 years, and then picking up another one in the next 20 years later, and then as the costs increase, you can't just consider that small premium for the term insurance. You have to factor in the opportunity loss of what that money could have made for you. Even at just a 5% rate of return, I calculated that buying those 3 term policies and what they could have made on that, and it's just a 5% rate of return, it's somewhere around $480,000 given away, and you end up only 1% file a death claim. So you've eliminated that cost. Now you have a lot of insurance companies now allow you to draw your death benefit early to pay for your nursing care, not just your hospice care, but your nursing care.
Right.
This is a big deal.
And you know what, Sean, if I could jump in really quick, because I want you to continue on that thought, but I just want to jump in and add fodder to your cannon right now, and basically tell everybody that's listening that you have to understand your policy. I beat this drum all the time. You may have a life policy already that is what Sean Quigley's talking about. You may have something that has a long-term care rider or benefit or access to a death benefit pool that you may be unaware of. And before you go purchase long-term care insurance, let's make sure that we understand what policies you already have so that you don't go spend more money on something that you don't really need. But maybe if you do need a little bit more insurance for long-term care, you just buy a smaller policy or something that complements what you already have. But I find that most of the folks that come into my office, they may have known back in the day, 10 years ago, 15 years ago, what it was that they were buying. But when asked today, they can't relate many of the basic important material facts related to their insurance policies. And it's just so important to have a review like that and to have these kinds of benefits, Sean. I think it's, for many people, when we show it to them for the first time, they ask me, how come everybody doesn't do this? How come nobody's ever told me that I should have done this, 10 years ago? How come my guy doesn't talk to me like you do, Justin? How would you answer a question like that, Sean? Or do you see that happening?
Well, yeah, that's a common question, because when you show them all the benefits, they say, well, why isn't everybody doing this? And I tell them, well, everybody that knows about it is doing it. But you haven't been taught this, and you need to find somebody that understands it. Everybody thinks that financial advisors are handed this book of knowledge, and they all know the same. They all do the same thing, and they all know the same thing, and who knows what they think. But there are advisors out there that are very good. I was just down in Atlanta, met 75 very good advisors, and they understand this. And Justin, I can tell you get it. And I'm not big into paying for insurance. I don't like paying for insurance if I'm not going to get a lot of bang for my buck.
Yeah, and Sean, to jump in real quick, I've had a number of clients that don't have children. They don't have really in their mind a big need for life insurance, in the sense that they, of course, they want their estate to be a little bit larger. They want their they'd like to gift money to a charity in some case, but they weren't out looking for life insurance. But when shown the opportunities and the value and the liquidity that comes with a proper laid plan, and sometimes it takes time. You can't just hop into some of these positions overnight. And what I found is that there is a window that people have to where this really works really well for them. But if you wait too long to do what's best, you may not have everything come to fruition in time for you to really reap as much of the benefits as you could have throughout the rest of your life by positioning your plan to include things that we're talking about today. And Sean, I have to jump to a break really quick as well here. When we get back, I want to talk more about how small businesses can use the cash play plan, a little bit more about college savings, and how we can get a copy of your book. Again, we'll be back with Sean Quigley. I'm Justin, Retirement Journey Talk 1370.
Lord, what you did to me, I spent all my years in believing you, but I just can't get no relief. Lord, somebody, can anybody find me somebody to love?
Talk 1370. You're listening to Retirement Journey with Justin Fort. You can call us live at 512-643-5483 or send us your questions and comments to ask@fortwm.com. If you have a question for Sean Quigley, our guest today, author of The Cash Play, Capitalizing on Your Opportunity Value of Cash, feel free to call us and ask Sean directly. Sean's book, we have a couple of copies.
We do.
And how can people get a hold of that, Jennifer?
They can call our office at 512-433-6492.
And you'll be happy to give it to them?
Yes, I sure will.
Okay, so if you'd like this book, and I think it's a great read. It's simplified, Sean. I think you did a good job of bringing it down to a level where all of us can read this, and we don't have to have a degree in finance or be a CFP to figure it out. And Sean, if I could quickly read an excerpt from your book, if you don't mind. This is from page 37. It's entitled "Take the Pledge." I really thought this was great. It says, you as an individual or you and your spouse must make a commitment that from this day forward, you and your money will be secure under any circumstances, not just in perfect circumstances. It is imperative that you make the decisions for your family and not listen to a friend next door, office colleagues congregating at the water cooler, or even so-called experts on the radio, unless it's Justin Fort. And I'm just kidding. And many of them are not
You're the best I've ever heard, Justin.
And many of them are not qualified to give you sound advice regarding sophisticated planning strategies, and you might be surprised to find out that some of them have had to file personal bankruptcy in the past. And you know what? That may even hold true for some financial professionals. So this is a fantastic pledge. I actually don't say it exactly this way, but I do talk to all of my clients, or prospects, I should say, people that come in. I asked them if they're willing and able to make the financial decisions that are in the best interest of them and their families. And if so, and they want and need help, I'm more than happy to do my best to assist them. If the answer is no, we're not prepared to do that because Joe Bob is my cousin and it's going to be awkward at a barbecue if we change our investment strategies, then you know what? I know that's going to be a waste of time and I'm out. I've got too many people to help here in the Austin area, and I'm sure that there's just so many people out there that just are thirsting for the kind of knowledge and the kind of advice that people like us have, and we're just so anxious to deliver it. We don't want people to get in the way of that are not serious about doing what's right for themselves and their families.
Right. And when you go to your friend or a colleague and ask them, what do you think of this? Everybody comes off as they've been so successful with their investments, and they, when people go to Las Vegas, they typically come back and tell you when they won. They don't tell you when they lost, and so everybody's taken some kind of losses, and so but to your friends and your colleagues, you want to look successful, so they tell you, that they give you their advice. Well, you got to decide for yourself and really listen up, even if you've never have in the past. And that's why in this book I really tried to make it simple. I use big letters, big font, so it's very enjoyable to read. It doesn't take long. But you were talking about business owners there before the break, Justin. And let me give you this short example. Like I told you earlier, I go into the University of Nebraska and teach the students there. And each year it's a lot of fun. I get them really riled up. And, well, this year I went in there and I said, we had so much fun last year. I decided I wanted to come in here and give you a graduation gift. And I'm going to give you $500,000 in cash.
That's a good gift.
Each of you.
That's nice.
Yeah, and they're pretty excited.
Let me know when you have your next event. We'll come.
Yeah, just sit in the back and you got your
$500,000. That's worth it.
So it's $500,000 in cash. It's sitting on your desk in front of you. It's for you to do with it whatever you want to do with it. And I said, I want you to think about what you would do with that cash. And you can imagine what the first one yelled out, I'm going to pay off my $250,000 in student loan debt. And trust me, most of them don't have their parents paying for it. They're paying for it themselves. And then another one yelled out, I'm going to pay cash for a home here in Lincoln. I can buy a decent home and pay cash for $250,000. And I said, time out. I said, wait a second. 10 minutes ago when I walked in here, you're coming up to me saying how, you have no money, you're living on top ramen, going through college, and when you come out, how are you going to start a dental practice? How would you even buy into a dental practice when you have no money? And I came in and I gave you $500,000 in cash, and it's there to do with whatever you want. And you had this sense of relief. Oh my goodness, I have $500,000 in cash. Now I've got game. So, but 5 minutes later, you spent it all and you're flat broke again. You're living on top ramen. I said, let's rethink this, because this is what we all thought when I was growing up. We paid cash for everything. I had paper routes, and I bought my first tennis racket. I paid cash, my first bike, my first car. But that was a different world, a very high interest rate environment. We're in a very low interest rate environment. And regardless of the interest rate, you need the cash to start your business at all costs. So you just pay down your student loans according to the repayment schedule. Be in no hurry to pay those down because that's cheap money. The mortgage rates are record low, so get your 30-year fix, put the least amount down, and pay that over 30 years, and it'll be paid off in 30 years. But keep that cash. So now you say you have $400,000 cash left. You can walk up to your dentist and say, I want to buy into your dental practice. Or you can build your own building and hire staff and purchase your equipment because you're cash rich.
Yeah, what you're talking about, Sean, is prioritizing goals. What's the most important thing? Is it the most important thing to have a house paid off, or is it the most important thing to be able to live in a house, maybe serviced with a mortgage, but then be able to use additional funding to start your dental practice? And I completely agree that planning should revolve around goal setting and allocating resources in a prioritization type way or method, and trying to do everything that we can do to not leave major risks lying around, right? There's many analogies I won't get into because we're almost out of time here. But Sean, I think that we've had a great opportunity today to enlighten some people on the cash play approach, which you've written a book on. I want people to get a hold of your book so they can read that for themselves. I think it's a good, relaxing read, and it may change some paradigms and at least provide you another way of viewing money and opportunity value of money, which is a lot of what Sean talks about there in the book. So, Sean, how can people get a copy of your book besides calling our office, which we've got a couple of copies? Remember, you can call us at. Go ahead.
They can. Oh yeah, you can. But you go on www.thecashplay.com and you can order it on there. And my number is 402-730-6505. If you don't mind, Justin, Jeffrey, I just want to mention a woman that helped me on this book tremendously, Paige Stover Haig. I just want to pay a tribute to her. She was diagnosed with terminal pancreatic cancer yesterday, and she doesn't have a long time to live. And she has just been so amazing for so many financial authors and other authors. She's just an amazing woman, and she's going to be missed. We have to keep her in our prayers, and hopefully she'll fight the fight.
Yeah,
but I just want to tell you, she's been such a cheerleader for this book and done such a good job. So, but I really appreciate the time here today with you, and people can go on the website. And I'd love to be back with you someday, Justin. I really appreciate the way you take care of your clients. It's really refreshing.
Well, tell Paige that we're pulling for her. We're sending our best. We're praying, and we'd love to have you back on the show again another time, Sean. Thanks so much.
Okay. You have a great day.
You too. Take care. So now, switching gears a little bit here to our news and views segment, I want to talk a little bit about this market volatility and what all this means to you, your family, your 401k. Should you be doing something different? Should you not? Is it a bad time to rebalance or reallocate when markets are down, or do we need to always have them up at the tippy top of markets, historically speaking, to be able to rebalance, to be in the position that you want to be? And I'll tell you, just cut to the chase, as we get, we'll come back from a break here, and get into the news and views segment. But you should always, 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 always be in the position with your finances the way you believe you ought to be. There is almost never a time that, there are some extenuating circumstances, I'm sure, but there's almost never a time to have your investments and your money in positions that you're not comfortable with. I don't think that's a good reason to not be in the place you want to be because markets are up or down. I don't think that there's a good reason to not be in the position with your finances and your plan goals the way that you know that you should be, because your friend doesn't think so, or because your financial professional you're working with doesn't agree with your ideas. I think you need to be in the position you want to be, and try to work with financial professionals that are going to help you get where you want to be and do that. And we should be careful with creating barriers for ourselves that are really almost made-up walls, or almost like the Don Quixote of our financial situation. These dragons out there are keeping us from doing the things we want to do. But you know what? They may just be windmills. And you may just be Don Quixote in that thinking pattern. We need to break that thinking pattern, and we need to see past it and see things the way they really are. And you need to be where you should be according to your wishes and your goals and your desires. And when I get back from the break, I'm gonna cite a couple of pieces from the News and Views segment here. And again, you're listening to The Retirement Journey with Justin Fort, Talk 1370.
Quite enough information.
It's Talk 1370. You're listening to Retirement Journey with Justin Fort, and we are going to speak briefly about this article that I found on countingpipes.com, entitled "The Two Faces of Stock Market Volatility." October 2nd, 2015. Which face should we be heeding? Which face? This is by Elliott Wave International. Volatility, volatility, volatility. It's all the financial world can talk about lately, and well, for good reason. In the past few months, the world's stock markets have endured some of the most gut-wrenching price swings since the 2007-2009 financial crisis. But for many investors, it's still not clear what this volatility actually means. Is this a good thing or a bad thing? Well, I really like this article. It talks about how sometimes we turn on the news, we listen to CNBC, we go to Market Watch, and what do we hear from the pundits? Well, market volatility hits 2015 low. U.S. stock investors haven't had much need for those crash helmets. It's looking like the market could be in for many more months of muted swings. This is May 22nd, so things were kind of calm, right? Investors who paid up for those options in anticipation of volatility have lost money in the last 3 years. So as a result, no one is anxious to do it anymore. And that's May 13th, Wall Street Journal. One of the more bullish indicators has been volatility, and it remains that way. Stocks can continue to advance as long as volatility isn't trending upward. June 23rd, Market Watch. And so what these three statements are saying and telling us is that with low volatility, we've got probably a bull market. Things are going to be good. Well, okay. So come August 24th, and what do we hear now? Quote, volatility is actually good for the stock market's return. That's Main Street, August 26th. Yes, the markets are volatile. That's a good thing now, somehow. Stocks have been too non-volatile for too long. You don't get up a lot markets. Big moves fast without abundant gyrations. You should expect this bull market to raise its tenacious head soon, bucking off all the fear skeptics can hurt at it. And that is from these pundits that you hear when you tune into the news. So it almost seems like whatever the case, volatility or not, it's a bull market. And you know what? We're all jaded. We all want the market to do well. We all want our stocks to go up. And we may have a bias, and so do, in some cases, the people that you hear on the radio or in the news. Well, volatility in the market for retiree can be a dangerous thing because we have market sequence or return risk as a financial planner, retirement planner. These things we need to be aware of. So just know that, we're aware of the volatility that's out there, but you need to have a plan in place to make sure that you're going to be okay, you and your financial plan, your retirement plan. Next week, we're going to have a money expert and one of the cheapest people in America, Denise Winston. She knows the ins and outs of saving, budgeting, and investing. She was featured in the Reader's Digest Cheapest People in America. I think she's proud of that, I hope. Some people might not like being called cheap, but Denise takes it as a compliment. There we go. And to her, it's chic to be cheap. She loves nice things. She doesn't like paying full price when she knows she can get everything for less by working the system to her advantage. Interesting. Next week, she'll teach you how to work the system to your advantage too, so you'll want to stay tuned for that. And she'll tell you all about budgeting and using the money you save to invest the way she's been doing it. And that'll be next Saturday, 12:30 to 1:30. We do have a seminar this week coming up, Tuesday and Thursday.
Mm-hmm. Tuesday and Thursday at Zed's Restaurant. So to RSVP, 800-769-1614.
And we'd love to see you there. Spaces are filling up, so
Yes.
feel free to give us a call at your leisure this weekend. And enjoy the rest of the weekend. It is beautiful outside, and we will do likewise. Thank you for coming on to Sean Quigley. Thanks to Matt Alvarez, our board op, and our producers. And thank you for tuning in and sharing this show with your friends and family. We're growing by leaps and bounds. A great way for people to learn more about their financial situation. And we will see you next week. This is Justin, Retirement Journey, Talk 1370.
Let's go live.